Now it's time for Hot Picks. Our next guest says that global U.S. stocks, bank stocks rather, are set to outperform the S&P 500 next year, given favorable fundamental trends and some key drivers as well. Joining us now, Ken Leon, analyst and global director of research for CFRA. Hi, Ken. Thanks for joining us.
Great to be here.
Okay, so let's start with your first hot pick today. Goldman Sachs. How much of this call has to do with the fact that you believe that President-elect Trump will bring in some policies and some deregulation, which will really ignite investment banking for this company?
That's definitely an important input, but we also see the underpinnings of a strong U.S. economy and really North America, which is how Goldman reports. Secondly, rates flat to down means that this will create opportunities for stability for the capital markets. And when we look at transactions, whether they be M&A or equity underwriting, which is well below capacity, we see opportunities there, particularly for financial sponsors, the private equity firms that need to monetize investments. So for Goldman, what we see is a premier bank, one that has arrested a failed strategy in consumer banking and is certainly refocusing resources not only to the traditional investment banking as an agent, but making principal investments in areas like a private equity firm. So we like it a lot.
Right. You make an interesting point in your notes about $1 trillion worth of private equity deals that may have been curtailed or held back just because of market conditions, essentially. So do you foresee a lot of these private equity firms finding the conditions are going to be right in 25 to eventually exit a lot of these positions they've held for a long time?
The answer is yes, and I am one of the few U.S. analysts that cover both these large banks, but also, the top 8 private equity firms. So it's a front row seat. Financial sponsors, unlike corporates, typically are 15 to 20% of investment banking fees, and it was like high single digits the last 2 years. So we're hearing it from those managements on both sides. So I think that's going to be exciting. CEO confidence levels is another factor. Corporates are going to be in there. 2024, we had a record year in fixed income, but we are significantly still below capacity on equity underwriting and M&A.
All right, another top pick is Morgan Stanley, along with the PE theme there, but also you think it's a leading beneficiary from the potential for reversing some of the policies under President Biden having to do with the Department of Justice and Federal Trade Commission as well surrounding M&A.
Yeah, I think in addition to what I've already said for Goldman Sachs, Morgan Stanley benefits from the rising equity market. The values filter into higher monthly service fees, a host of different fees that comes to Morgan Stanley as the largest wealth manager in the world. So they're really not doing anything away from their core businesses, which is asset and wealth management, along with investment banking. There was a great transition to a new CEO last year. And we think, again, Goldman and Morgan Stanley, a number of the bank analysts in the U.S. are worried about a decline in 25 of net interest income. For the large banks, it's anywhere 55 to 70% of net revenue. Morgan Stanley and Goldman, it's only about 14%.
And your other top pick among the large U.S. banks is JPMorgan. Many say this is best in breed, essentially. You think investment banking has troughed for this company, and also that they're seeing less global competition for underwriting and various other types of investment banking business. Why is that? Is that because some of the international banks are just weaker right now?
They are. So U.S. investment banking fees is about 45%. Europe could at some point come back. Asia, less so, because a lot of it is done by Chinese-based banking for China. Additive to my comments and the buys here for JPMorgan is valuation. So there's worries when bank stocks trade above 2 times net tangible book value, we're okay with it. We're okay with that. And we looked historically back over 10 plus years, and there have been periods twice where you can still get very good performance of your investment in JPMorgan shares. They're gaining wallet share in the traditional areas of consumer banking, lending, credit card. And this weekend I was in New York and just walked by their new headquarters, which is pretty neat. It's pretty impressive in Midtown. So succession, unlike other industries, JPMorgan, Jamie Dimon probably still going to be around, but he has a whole lineup of great candidates if he chooses to move on at some point, even to just chairman from CEO.
And lastly, Ken, with JP Morgan, Morgan Stanley, and Goldman Sachs, your three hot picks today, there's always talk about geopolitics, and you probably couldn't have more disruption the last couple of years in terms of geopolitics, and yet banks and stocks in general just keep marching higher in the United States. And you point out that 3/4 of these banks' revenues comes from the U.S., so they're insulated, are they not, to a large degree?
Well, they're insulated, but in order to get more organic growth, we need to see a recovery from the rest of the world, and specific to Europe and Asia. So I think that creates an opportunity. Additionally, when you think about geopolitics, investing in these stocks, it's not necessarily the news story, but it's the effect it might have on different securities or derivatives where there's a liquidity gap. And a liquidity gap sometimes leads to some kind of crisis. In some of these large banks, it's kind of, the black swan we're never expecting. Certainly that was the downfall of Credit Suisse, which no longer exists and was merged into UBS.
All right, you make some great points there, Ken. Thanks for your time today.
Thank you. Happy holidays.
You as well. Happy holidays. Ken Leon, analyst and global director of research for